Okay, 50 points lower, 19,623, so about 10-15 points off the lows of the days where we're at. Market breadth, I think, has again slipped. It's been up and down, but now 200 stocks more on the declining side as compared to what is up. So market breadth is slightly on the negative side. Rohit Srivastava is now joining us. He's, of course, with IndiaCharts.com. Rohit, good to have you with us here. Speaking after a while, thanks for your time. So, interesting time to speak to you because things are moving, not in the direction we're all used to, which is up. There is a little bit of down also. So, what's your assessment of things right now for the market here? And if this is a bit of a global pullback, I mean, the impact is coming from what's happening globally. I guess we need to talk about that as well. Go on.
So I think a large part of this recent correction somewhat to do with options expiration. Even in the US, you had triple witching a week back, and then you had the Fed policy. And in India, you have what I call the pre-expiration week for the stock options. So from Friday onwards, margins apply. And so usually that leads to some unwinding most of the time, 80 to 90% of the time we've seen that happen. And in that sense, we were anticipating this pullback last week. Now that it's happened, the question is, was this just a routine correction? Because once you get a correction, then everybody seems to get scared because there's too much negative news flow. And that's been one of the unusual parts, I think, about this entire rally, that at every step of the way, you have a lot of negative news flow, a lot of questions to answer, especially about the global landscape. But if we just look at our own market, and I was just thinking in the morning, you have an earnings growth of almost 30% for this last quarter. What has been the quarterly return of the Nifty? It's barely 5%. The 6 monthly return is around 15%. So in a sense, we are trailing far behind even the earnings growth, which is why if you look at the PE ratio, it's actually stagnating. It's not going up. It's stuck at 21, 22 for the last 3 to 4 months. So essentially, I think it's this negativity that is keeping the main index or the large caps from really participating on the upside. But money's continued to chase up the mid and small caps. And that is where I think some of the concerns were in the short term. Now, we've seen a correction there as well. So generally, I think our market's going to find support somewhere and pick up again. We are at a very good level for that to happen. 61% retracement on the Nifty at around 19,600. Sorry about that. And around, for the bank Nifty, it's at around 44,361, a 78% retracement. So I think those levels should really hold out. We should see the upward move resume. In fact, a few people would have noticed that the put-call ratio for US equities has actually reached a high that has been associated with many medium-term market lows. So it's really shot up pretty sharply, which shows that a lot of put buying or put trading is happening, not buying. It's volume. So essentially a lot of put trading, which again is a gauge of short-term fear getting overextended into this fall, mainly because of the bond market. And I think it's just due for everything to reverse. Just a matter of time. You just need a little bit of patience, and Indian market seems better poised in that entire scenario.
Okay. Rohit, that is what you spoke about, the Nifty and Nifty Bank. But in the sector-specific moves, IT is one which is not doing so well. Do you think it's a good time to still buy into those dips, or do you think we could see some more pressure here?
So if you look at the tech sector and a couple of others, one thing is looking at the day's performance. So surely for the day, it may look like the IT index is down. But if I just, take a 10-day view and I look at, how many of these indices are actually holding out better than the Nifty, which means, let's say, how many of them are greater than the 20-day moving average. And essentially, these include the auto, IT, energy, PSU. All these sectors are holding out above the 20-day average, which means they're showing relative strength compared to the Nifty or the bank Nifty. And which is why I would think, as your question asked, that these would be the buy on dip sectors because they are actually showing strength. In fact, I was slightly concerned about PSUs a week back. But despite the steep correction, you're actually seeing them hold out very, very well, which now gives the contrarian signal that they would actually continue to outperform in the near term.
Rohit, while you do believe in the inherent strength in the Indian equity market, it's just that we can't be isolated from what's happening on the global front. And global markets have had a rough last week. In fact, the whole of last month has been quite dismal for US markets. What are you seeing on the charts of the Dow, the S&P 500, in general global backdrop, with crude where it is in the dollar index well above 105?
So like I just mentioned, the PCR, that is the put call ratio, is showing that US equities are getting to a point where they may be very oversold. I'll still leave maybe around a 1% room for downside risk as far as the S&P or Nasdaq is concerned. I don't think it's going to go much more than that on the downside. So we should be very, very close to a turning point looking at that sentiment gauge, which means that sooner than later, give it a day, because the Fed meet just happened Wednesday night. You've had Thursday, Friday, 2 days of market reaction. Typically, that's sufficient. Give it one more day, 3 days of market reaction to the news that was already sort of considered discounted, that, the Fed's going to pause and keep one rate hike in the future on the table. So it's not new news, So what's really causing all this concern? It's actually the bond yields that are moving higher and higher every day. And the fear that, the US needs to issue a lot of treasury for the rest of the year because they've got a large borrowing program, and maybe that's the reason why we see pressure on the US bond market. However, there may be a limit to how far even the US can allow these yields to continue to rise. I sense that at some point the Fed is going to have to fund that deficit. They just can't let it run its course. So it's only a question of timing. When does the bond market really bottom out and turn around? Because sentiment, now let's take the daily sentiment index from trade futures, is down to around 12% for the US 10-year notes. So US 10-year notes, you have like more than 88% people being bearish on the US 10-year notes. That again puts us at an extreme in terms of sentiment. The positioning also is you have the largest, I think, multi-year short position on the US bond market. It's waiting for a trigger to turn around and, end up being a massive short covering rally. So you can't really get too extremely bearish on US bonds. That would be a wrong position to take. But yes, in the short term, as long as yields are remaining high, it continues to put pressure on US equities. So that concern is there. I think it will go away. I just don't know whether it's 1 day or 1 week that it will take for these concerns to end. But the put call ratios, like I mentioned, for the US equity market do indicate that they are very, very oversold.
Yeah, no, point taken, and interesting point there. But the only thing is, some of these things, I mean, the US market is up strongly this year, the Nasdaq especially, right? Now, on an equal weighted basis, one can argue and say that it is not, but the index, the way it is constructed, it is up very strongly. And it's pulled back only a little bit. So, is it a big is it very oversold? In absolute terms, it is not. But in the very near term, as you say, the PCR may indicate that perhaps things have gotten a bit too much one-sided. The other point is, even if yields were to come off, right?
Yeah.
It's not as if equities have been under huge amount of pressure this year because yields are where they are. So if yields were to come off, should that really mean a big boost to stocks? Because they didn't get hurt in the first place.
So I'll tell you how the hedge funds have been talking about this. I listened to dozens of them. And all of them have been looking at this. If there's a bond market rally, it will be a risk-off trade, which means bonds will go up because something went wrong and people will sell stocks and buy bonds. The basis for this trade is essentially the last two cycles, that is 2000 and 2008. Both of these cycles were situations where that's what happened. Whenever there was risk, bonds got bought into and equities sold off. But let's remember 2022-23 were very, very different in the sense that this was the first time we've had an inflationary conflict. 2000 and 2008 were deflationary periods. They were associated with deflation, low inflation, low prices, and therefore very low interest rates could follow. This is not the same situation. You have now an inflationary cycle, and therefore we cannot compare eggs with apples, right? You have to compare another inflationary period, in which case you go all the way back to the 1980s or the 1970s. You can even go back to 1950s. And then when you do that, you'll get a very, very different outcome in terms of what you should expect. Because 2022, 21, 22, most of the funds that were doing risk parity trades, which is long equity, short bonds, or long bonds and short equity, they actually ended up losing money because both went down. So even if they had a balanced fund where they say, okay, 40% equity, 60% debt,
Sure.
they lost money on both fronts. So this was very, very new for them, and therefore I think they are also unprepared for the reverse. That is, that bonds and equities can rally together, just like they did in previous inflationary cycles. So moment inflation cooled off and bond yields cooled off, equities actually took off in the 50s or in the 80s. And that's, I think, going to be the scenario in the current context, that when bond yields actually start to drop, it's not going to be a risk off trade. It's actually going to be a risk on trade where both bonds and equities rally together.
Rohit, out of time. Thank you very much for joining in. With that, in fact, we're out of time on the show, Trading Hour. Thank you for watching. Stay tuned. Halftime Report is up next.